They are making a mistake here, and I really do believe they are now making a mistake, tightening into the teeth of what seems to be a very significant slowdown and inventory bulge in the economy. So we were watching 2 points of view based on the same data. One was we are back in the 70s environment. Inflation is baked into the cake. It's going to be very difficult to dislodge it. And we're probably in an environment where commodity prices, real estate, tangible assets generally are going to do much better than the financial markets. And so we were dealing with that scenario. And as you know, we were looking at data and actually more than a year ago anticipated a very different world. What we didn't anticipate, of course, was the extent and the length of time that we were going to see supply chain disruptions. And we certainly did not expect Russia's invasion of Ukraine. So those have been variables we've had to work through in terms of our own thinking about the future. But we did come to the same conclusion that we were probably going to see more deflationary forces at the end of all of this than inflationary forces. And I believe that we are in the early stages of seeing that. The Fed is really focused on the US, but I think Europe is in a recession. China, some of the numbers coming out of China are shocking as well. That has an impact on the rest of Asia. So what they're facing is a recession, and their currencies are dropping. Their currencies are dropping relative to the dollar, which means their purchasing power is going down. But it also means that some of them are tightening more because their currencies are falling against the dollar. So it's a bit of a vicious cycle that those who are listening will say, oh my gosh, this is terrible. And it is in one way. But one of the things we're focused on is what will get the Fed to stop tightening, or at least change its rhetoric. And I think as these forces put pressure on the economy, and you get companies like Walmart and Target reporting terrible numbers from 2 points of view, their sales up 3% year over year, while inflation itself is up, if you looked at CPI, 8%. Now, they're not passing all of that through, but I am sure that they are passing more than 3% through. So that means their unit sales, their real sales, are declining on a year-over-year basis, while inventories are ballooning. And we think that those two factors, and now the Fed must be aware of them because Walmart's such a big, and Target's such big companies, those two factors probably have gotten the Fed thinking, my goodness, are we overdoing it here? Well, one of the things that would be interesting to know is, have we ever seen inventories, Target or Walmart, have their inventories ever increased this much? So Target's inventories, their unit sales were probably down. 3% was the dollar value, but in units, probably down. And their inventories were up 42%. So take away inflation, that's 30 to 35% on a year-over-year basis. I do not believe we've ever seen that before. And these are well-managed companies. And so what I think happened was human beings overruled their enterprise resource planning systems, their software, and they did double order and triple order. I know that Target said part of the disappointment in sales and earnings was they had to start marking down goods in order to start clearing shelves. And even with marking down in April, these are through April, their inventories were up 42%. Walmart's were up 33%. Home Depot's up 32%. So much for supply chain problems. I mean, those, at least in the case of those three companies, the supply chain issues are disappearing. You know, during tough times, innovation gains traction. And so in the retail sector, which we focused on in terms of the inventory excesses, we are also beginning to wonder if there's an accelerated shift now taking place to online, now that energy prices have soared. And because if you look at total online sales as a percent of retail sales, that number in the United States is 15%. In China, it's more like 45%. Normally, when you get a trend, a consumer trend moving through that 15% mark toward 20, it's a trend that's moving into overdrive. So those bricks and mortar retailers who enjoyed such a nice rally last year as people were going back to stores and so forth, they are probably now facing a day of reckoning. These energy prices are preventing trips to stores. And so we would not be surprised to see a lot of carnage in the retail sector. The reason a lot of people think core CPI will be sticky is rents, because housing prices have gone up so much, rents have gone up so much. I think what's going on the good side is going to overwhelm what's going on the rent side. And we're even seeing signs in some places that the consumer just can't pay up for these rents anymore. You're seeing a lot more mobility, and I have a feeling even rents are going to start adjusting. This is why the Fed will relent. First, they'll relent in terms of their rhetoric. You'll hear them talk, well, maybe we don't have to go up as much. But my guess is they will stop their tightening moves at some point this year altogether. And the stock market discounts the future. The stock market is looking very carefully at these numbers to discern trends out there. And as soon as the stock market understands that inflation is going to unravel and that the Fed is actually going to relent, because they are making a mistake here, and I really do believe they are now making a mistake, tightening into the teeth of what seems to be a very significant slowdown and inventory bulge in the economy. I think that the equity market is going to take off again. But what we will see first is a rotation. And, on certain days we're seeing it. But the last year has been all about cyclicals and value stocks. There will be a rotation back to growth stocks. Growth is going to become very scarce out there. And so that true growth companies with strong revenue growth in the 20% plus range, to the extent there are companies like that out there, they will be rewarded handsomely as the market shifts away from value back to growth. And we know that the dollar is up 15%. That's a powerful anti-inflationary force. We mentioned the 10-year bond yield, saying, Fed, you might be making a mistake here. And we're beginning to see that in other fixed income metrics, like the yield curve. The yield curve has flattened from 150 basis points more than a year ago down to roughly 20 basis points. It went negative for a minute, but what this also means is the bond investors believe that inflation or growth is going to be disappointing. And so that's interesting. Typically, when the yield curve goes negative, there is a recession within the 12 to 18 months. And that's certainly post-World War II experience. If we're right, we're going to revert to something like the early 1900s experience, where if these deflationary forces start dominating, that we could have inverted yield curves more often than not. In the 50 years ended in 1925, the yield curve was inverted 60% of the time, and the average inversion was 100 basis points. That certainly will be a new world. The other variable we're seeing here, credit default swaps, those are breaking out. These are insurance policies that investors take out against bankruptcy. And even JP Morgan, I took a look at that. Now, banks are very well capitalized. We're trying to figure out why this is happening. But JP Morgan's credit default swaps are priced today above where they were in the fourth quarter of 2018 when the market absolutely fell apart, and are moving towards COVID highs. Now, why is that happening? I think there are a lot of deflationary forces out there, and if there are deflationary forces and a company has leveraged up to buy back shares and cater to short-term oriented shareholders, then they are going to have to service that debt by cutting prices on products that are probably going obsolete or that are over-inventoried right now. So I think we're going to hear a lot more about deflation, and I think you should be watch very carefully the leverage in your companies and whether or not their products are in an over-inventory situation, or whether they're going to be obsolete